Good morning and welcome to Financial Accounting. Today is our last regular day of class. Today's day 29 for the semester. So we will be finishing up to chapter 14 exercises today. We will start with exercise 6 here in a moment, and we will move through the rest of the material for this half of the book. So as you look at your calendar, the chapter 14 exercises should be submitted for grading by the end of the day. Then the chapter 14 problem due on Wednesday. And Friday will be the final day to submit any work for the semester, including the last exam and the last piece of the project. Wednesday is officially a class day, that's day 30, but because we will have covered all of the new material, we'll be treating that last day like our drop-in review sessions that we've been having the last few weeks, or last half of the semester. So if you have questions, if there's anything you want to go over, any last minute concerns, you can come to class on Wednesday. I will, of course, be here on campus, and I will open the Zoom link as I do every class day. And if anyone's here, we'll go over whatever you want to talk about. And if no one is here, I will close the Zoom link and go back to my office and wait to be contacted when questions come up. So final week. Final grades are due 1 week from today. And I think I've already said this. They're officially due at 5 p.m. My goal would be to have them in no later than the morning because I have things booked all afternoon. But also for this class, your grade in Banner will match whatever's in Blackboard. And so once you see that all of your grades are in and anything that you did not submit has been converted to a 0, you can be confident that that is your final grade. I will also change the name of the column in the Blackboard gradebook to say final grade rather than current grade, so you'll know that that's your final grade. And I have even been known to post an announcement that says, okay, everything's done. Now you can be sure that what's there is your grade. As always, if you have questions about that or anything you see in the gradebook, in particular, if you think I miscopied something, I do manually copy all of the grades from Cengage into Blackboard, so it wouldn't be unheard of, wouldn't be impossible for me to copy something incorrectly. If you think there's something that's a mistake, please feel free to bring that to my attention. Obviously, especially if it works against you, not intentional, they should all match. And so if you see something, just send me a note and ask me to take a look at it, and I will be glad to do that. Okay. Any questions about anything we talked about last time? We introduced the idea of doing financial statement analysis. We talked about the 3 standards of comparison, and then we looked at both horizontal and vertical analysis for an income statement and for a balance sheet. Our last thing that we did together in class on Wednesday of last week was an analysis of receivables turnover. I gave you what I believe to be an easier way of calculating the days sales uncollected calculation. Any questions about any of that? All right. If not, then we will jump into our new material for today. As I said, we'll be starting with exercise 6, and the first topic is inventory analysis. So back in chapter 6, when we talked about inventories, we talked about the kind of balancing act, more of an art than a science to know how much inventory you should be carrying, because there are costs associated with carrying inventory, not the least of which is you had to pay for it, and now it's just sitting there in your warehouse or in your store waiting for someone to buy it. And so we need to have a way of analyzing whether we're carrying the right amount of inventory. And so the two related calculations that we'll be doing in exercise 6 are inventory turnover and number of days sales in inventory. And just like for receivables turnover and the related number of days sales in receivable or days sales uncollected, I will give you what is an easier way of calculating the second of these two. These two calculations are absolutely related. And so if we're going to calculate both of them, in my mind, it makes sense to use the first one to calculate the second one rather than doing what appears to be a whole new calculation as they present it here and in the textbook. So as I said, there are inventory carrying costs. We need to be very cognizant as we're running our company to make sure we're not carrying too much inventory so that we have all these excess costs associated with it. We have to store it. We take a risk that something happens to it, that it goes out of style, that it spoils, that it gets stolen. At a minimum, we've already had to pay our suppliers, as I suggested, and we're also paying employees, and we have costs tied up in actually having a warehouse to store all of this stuff and to have people move it around. And so we want to balance having not too much inventory so that we have all these costs, but at the same time, we don't want to have so little inventory that we lose sales because we don't have the product available when our customers want to buy it from us. You may want to make a note of this first calculation, the first formula for inventory turnover. Cost of goods sold, that comes from the income statement, of course, divided by average inventory. So we've talked about that. How do we calculate the average? Again, last class we talked about how do you find the average receivable. Same concept here. We have to use the information we have available to us as someone outside the company trying to analyze that company. And so what do we know about their inventory? We know their beginning balance and their ending balance. And so to find the average inventory, we're simply going to add those two numbers that we have available to us, add those together and divide by 2. So it's an arithmetic average or a straight average. It's not weighted or anything like that. So cost of goods sold from the income statement divided by average inventory. Inventory turnover is expressed as the number of times. And so this would be the number of times that we sell through our inventory on average in total during the year. So the higher the number, the more efficient the company is at turning over or selling their inventory more quickly. So from a liquidity standpoint, inventory turnover, the higher the better. Again, we have to balance that against, yeah, but do we have enough inventory to meet customer demand, or are we losing sales because we're so good at managing our inventory, or we think we're so good? We're not going to go through that example because we're going to do our own. I'm not suggesting that you write down the formula that you see on this next slide, because when we go to exercise 6 in just a second, I'm going to tell you an easier way to calculate this. But I want you to be aware that the formula that I give you mathematically is the same as what you see here, but this is really a 2-step process, and I'm going to tell you a 1-step process to follow if you're already calculating inventory turnover. So let's go to our first exercise. The right tab here. Is that big enough to see, or do I need to make that a little bigger? Everyone see that? Okay. Did you get your hair cut, Michael?
Huh?
Did you get your hair cut?
Yeah.
Looks good. Looks very different. I couldn't tell you, but I don't know, was it a lot longer last week?
Yeah.
Okay. I wouldn't have been able to tell you that, but looking at you now, something looked different. So the following data were extracted from the income statement of Keever Incorporated. And so we're given sales. Again, that would come from the income statement. We have their beginning inventory and their ending inventory. You'll notice that the ending inventory from the previous year is the same as the beginning inventory for the current year. Of course, that's always going to be the case. And then we have their cost of goods sold. So I ask you to make a note of the formula for inventory turnover, but I will put it here on the screen just in case you did not do that. Oops, cost of goods sold divided by average inventory. So that's the formula I had asked you to make a note. So let's do the current year together. Our first calculation is inventory turnover. So let's find the average inventory current year. So as you know, we take the beginning and ending inventories, we add those together. Does not matter which order you add them, because addition is commutative. So let's add those together. Make sure you do add them first and then divide by 2. So if you're just plugging this into your calculator, make sure that you are putting grouping symbols, parentheses, around that numerator. And then divide by 2. And I would always encourage you to do a reasonableness check on that number. So the average, of course, needs to be somewhere between the two numbers that you're averaging. The straight average, it needs to be exactly halfway between. So if you come up with an inventory average that's lower than the lower number or higher than the higher number, you know that you must have done something wrong. And probably what you did wrong is either you plugged something mistyped into your calculator, but more likely is that you forgot these bracketing symbols. So now we have the average inventory. We can go ahead and calculate the inventory turnover by taking the cost of goods sold. Again, we're working on the current year here. And then dividing that by the average inventory. So what is it we're calculating here? We're saying that during the year we sold, I'm just going to round off, during the year we sold $9 million worth of stuff. And at any given time, we have about $1 million worth of stuff available. So our inventory turnover of, oh, exactly 9. Look at how convenient that is. Our inventory turnover of 9 means that we are selling our whole inventory about 9 times a year. That makes sense? What it is we're calculating. So we express it as a number of times. Our inventory turnover is 9, or 9 times a year we're selling through our full inventory. Now, are there some products that take a little bit longer to sell and others that sell more quickly? Of course, that's the case. If you think about a grocery store, things like milk and eggs, you hope you're not holding on to for a month and a half, but maybe the Campbell's soup is on hand for, you know, a couple months on average. So this is an on average number. Inventory turnover, on average, we sell all of our products 9 times a year. Now, I told you I was going to give you an easier way of calculating the second piece here, which is the number of days sales in inventory. So I showed you the way the book presents it, the way it was in the PowerPoint, where it's really a 2-step process. But as I said last time, with the receivables turnover, same holds true here. Let me see, maybe I can fit it right in here to take up all of that white space. So we can calculate our days sales in inventory, and I'm just going to call it days sales to give myself a little bit more room here. Just like we did with receivables turnover, we can take 365 days and divide by the number of times, divide by the inventory turnover. So you can save yourself a step. You'll get the same answer either way. But as long as you've calculated inventory turnover already, it makes sense to me to simply use that in our second calculation. So 365 divided by 9, and it asks us to round to 1 decimal place, which would be 40.6, because it's 40.555 by 555. So on average, another way of understanding this, on average, it takes us about 40.5 days to sell a piece of merchandise. Or another way to think of that, we sell through our entire inventory about every 40.5 days. Any questions about what we've done so far? And you can use the calculation the way the book provides it to you. It's just an extra step. But you'll get the same answer. All right, so if there aren't any questions, I'm going to ask you to try the previous year calculation on your own. I'll put mine on the screen here as well. And I'm going to pause the recording to allow people to do that on your own. And then once you have those two numbers, restart the recording. So for the previous year, I got an inventory turnover of 12 times. So if we're turning it over 12 times a year, that's about once a month, or 30.4 days, number of days sales in inventory. So we talked about last week 3 different standards of comparison. And the first one that I mentioned was a rule of thumb. There really is no rule of thumb for inventory turnover that works for the majority of companies, because it's very much industry dependent. So I use the example of a grocery store. Grocery stores are going to turn over their inventory every couple weeks on average. Again, that doesn't apply to every product, but things like milk are going to turn over much more quickly than things like canned or frozen goods. But then if you look at an organization like a department store, if they're turning over their inventory about 4 to 5 times a year. Think about it. You go to Kohl's or JCPenney, the merchandise turns over with the seasons, basically. And so that's about 4 times a year. So you wouldn't compare inventory turnover from a grocery store to a merchandising organization like JCPenney. It wouldn't make sense. So we don't really have a rule of thumb, but we can look at the other 2 comparisons, which is comparing ourselves to ourselves, that time series or longitudinal analysis or horizontal analysis. Those are all different ways of looking at how are we doing this year compared to how we did in the past. And so when we look at this particular company, we can see that they turned their inventory last year much more quickly. So they had on average 30 days worth of inventory on hand compared to 40 days this year. And so they're selling their merchandise more slowly this year. What do we see here in the information that's given? Their sales actually declined, while at the same time their inventories were climbing. So they have more inventory. There's probably a relationship there. Maybe the economy slowed down or demand for their product slowed down and they didn't recognize it immediately. The buildup of inventories is actually a leading indicator for the economy. That companies keep buying or making inventory at the same rate, and it takes a little bit of time to recognize that, hey, people aren't buying as much. And so those inventories build up. That may be what happened here, just one idea. So how do we look at this? How do we make a decision? The other standard of comparison is comparing to an industry average. So if we knew what industry this Keever Inc. was, we could look up very easily online on Yahoo Finance or any one of a number of sites. What's the industry average? How are they doing compared to their industry? And it may be that having 40 days of inventory on hand is more appropriate in their industry. I don't know, but we need to know something more about this company. So the only thing we can say for sure here is that they're turning their inventory more slowly this year, and that has an implication for their liquidity because of those inventory carrying costs. So let's go ahead and answer the questions that are asked here. And I'm going to just ask you to take this with a grain of salt. This exercise makes an assumption, and the assumption is based strictly on how does this affect their liquidity. It doesn't really speak to what industry this company's in and whether inventory turnover of 12 or 9 is more typical. We don't know. We're only talking about how does this impact their liquidity. And from that standpoint, the inventory position of the business has deteriorated. They're holding onto their inventory longer. The inventory turnover has decreased from 12 to 9, while the number of days sales in inventory has increased. And just like we said last class, there's always going to be an inverse relationship between these two numbers. If inventory to turnover goes up, it must be the case that days sales in inventory goes down. It's easier to see that or see why that's the case when you use the formula that I gave you for days sales in inventory, because we put that inventory turnover in the denominator right here. Whoops, right here. We put that in the denominator, there has to be an inverse relationship. So now to the, what else can we glean from this information? The sales volume has declined faster than the inventory, resulting in a deteriorating inventory position. So as we already pointed out, their sales are lower, but their inventory was building up, and there's probably, certainly realistically, could be a relationship between those two things. Any questions about inventory turnover calculations, what they mean, how to interpret them, anything like that? I know I said this last week, but I want to repeat. It's very dangerous to take any one of these calculations that we are reviewing and look at it in a vacuum without keeping in mind the big picture. And so we would not want to look just at this company's inventory turnover and disregard everything else that's happening in the company. This gives us one little piece of the picture for this company's liquidity. But we also want to look at receivables turnover, like we talked about last class. And as we're going to go into in the next exercise, looking at their long-term solvency, looking at their debt to equity position and things like that. So it's not just, there is no one calculation that we're looking at in this chapter that gives us all the information we need about a company. Whoops. There we go. Okay, any questions before we keep going? All right, well, let me go back to our PowerPoint. I'm going to skip ahead here to that slide. So we've talked about liquidity, we've talked about profitability. We are now going to look at solvency. So solvency is different from liquidity, as we said last time, because solvency refers more to the long-term picture, while liquidity looks at that short-term picture, receivables, inventory, things like that. The quick ratio, the current ratio we talked about last class as well. So solvency looks at that long-term picture. And so we have a couple solvency ratios we're going to be looking at in our next exercises. Ratio of fixed assets, so the property, plant, and equipment stuff, the long-term assets, to long-term liabilities. The ratio of liabilities to stockholders' equity. So both of those ratios are looking at the balance sheet, comparing different categories on the balance sheet. As I said, we talked about last week and all the way back in chapter 4, some balance sheet ratios already, but those were focused on liquidity, on the current assets and current liabilities. When we talked about current ratio, the quick or acid test that we talked about last class, working capital. Those were all looking at our current or operating accounts. Now in these first two ratios that you see here, we're looking at the balance sheet again, but different parts of the balance sheet. We're looking at the long-term picture here. And then the third calculation, times interest earned, is actually going to look at the income statement, not the balance sheet. So you may want to make a note of this calculation or formula. Remember, I did show you last class that in the Chapter 14 reference materials folder in Blackboard, I have a couple of snips out of the book with all of these formulas there, not the shortened version of the days sales uncollected and days inventory on hand that I've given you here in class. But those formulas that they provide will work. They're just an extra step. So you may want to make a note of this formula, but to me, it's pretty self-explanatory. A ratio already means we're going to be comparing one value to another in a fractional sense or fractional expression, I guess I should say. Fixed assets from the balance sheet. It says net, so what does that mean? As we talked about in Chapter 9, it means net of the accumulated depreciation. So what is the book or carrying value of those fixed assets from the asset side of the balance sheet? And then we look at our long-term liabilities. So we're not looking at things like accounts payable. We're looking at, do they have any bonds outstanding or mortgages or other long-term liabilities, long-term notes potentially. I'm not going to look at that example. Here's this second formula. Again, you may want to make a note of this. Ratio of liabilities to equity. So this is our total liabilities and total equity. Those are both what I refer to as the credit side of the balance sheet. So we're looking at the relationship between how much we owe our creditors and how much our stockholders own. I'm going to show you the times interest earned calculation. It's not included in this exercise, but as I told you, it is an income statement calculation rather than a balance sheet calculation. And here's the formula. This numerator has a special name in financial circles. This numerator is referred to as EBIT. EBIT, which stands for, earnings before interest and tax. Taxes. Just trying to shorten that up a little bit. So if you follow, the stock market, I didn't put a closing on that parentheses, did I? If you follow the stock market, if you watch any kind of shows on television or listen to any investing kind of shows, you may have heard that expression EBIT before. It's very commonly used. And it really is that same number that you see here in the numerator of the times interest earned. So we look at the income statement. We say, how much money did the company make before they had to pay the interest expense and the taxes? How much money did the company make compared to the interest that they had to pay? And so since we're adding back the interest expense here, you can already tell that the numerator, unless the company lost money, the numerator is always going to be bigger than the denominator. If the numerator is negative, if the company lost more money than they paid in interest, and so you end up with a negative number in the numerator, you should just not bother doing this calculation. It's not going to be meaningful. But as long as the numerator is a positive number, it's how many times the interest they had to pay was their income before they paid the interest. And so the higher the number, the more safe this company is, the less risky they are, the more profit they have over and above the cost of generating that profit. Oops. Clear that over here. And we will go to our next exercise. So any questions about that at this point? Questions you want to ask? So for what it's worth, the description or the name of these ratios is pretty pretty clear. It tells you exactly what the ratio is going to be. Liabilities to stockholders' equity. So let's do that for Mondelez. Now, Mondelez and Hershey Company are both food companies. And so we might, if we're a Hershey Company, we might want to compare ourselves. How are we doing compared to Mondelez? And so if we just look at these numbers on here, what do we see? Across the board, Mondelez is a much bigger company than Hershey is. And so if we just compare dollars to dollars, every single line, we're going to say Mondelez is doing better. But that's an argument for using what we called last week, the common size financial statements, to be able to express them as percentages rather than in these raw dollar amounts that don't give us any useful information, because again, Hershey comes up short on every single one of these comparisons. But doing a ratio analysis like we're doing here is also beneficial because again, it takes out the raw dollar amounts and just shows them as percentages or number of times, and will allow us to make a more reasonable comparison between these two companies. So let's do Mondelez first. Let me get my annotate up here. So the first thing we're doing is the ratio of liabilities to stockholders' equity. So for Mondelez, we have current liabilities, long-term debt, and other long-term liabilities. All of those make up our total liabilities. We need to add all of those together. If you're wondering why did they give them to us separately and then make us add them together, it's because we're going to need, for the second part of this, we're going to need them separate. And so for Mondelez, we want to add together the three pieces that make up their liabilities. And then divide that by their equity. Oh, and it says round to 1 decimal place. Sorry, decimal place. 1.4. So we think about, just put this up on the screen for you, the fundamental accounting equation, assets equals liabilities plus stockholders' equity. I'll just abbreviate there. Assets equals liabilities plus stockholders' equity. It could be that the liabilities are greater than the equity. It could be that the equity is greater than the liabilities. There's no set pattern. But what we can say is the higher the company's liabilities compared to their equity, the riskier that company is. And the reason for that is because liabilities have to be repaid. And many of our liabilities include interest. Certainly the long-term liabilities include interest. And so the heavier liabilities a company has compared to their equity, the riskier that company is. Now, I really shy away from suggesting that risk is bad because it's really individual investor preference. Some companies really like companies that have a lot of debt in their capital structure. We would say that that company is highly leveraged. So when you hear discussion of the leverage of a company, what that means is there's a high level of debt compared to their equity. Highly leveraged, there should be a D on there. High leverage or highly leveraged. If you hear discussion of the leverage of a company, they mean the debt of a company. And so some investors might be very risk averse and be looking for a company that doesn't have a lot of debt. And other investors might prefer a highly leveraged company because it increases the possibility of high returns. And I'll talk about that more in a second after we do do the next calculation. So let's go on then to the ratio of fixed assets to long-term liabilities for Mondelez. So the fixed assets are the property, plant, and equipment. We already pointed out that that's net of the accumulated depreciation. So this is the book value of their fixed assets divided by their long-term liabilities. And you can see that Mondelez has two different components there that are long-term. They have their long-term debt and other long-term liabilities, which could include things like pension obligations and things like that that are more long-term, but not debt per se. So go ahead and do that calculation. Oops. And it tells us to round to 1 decimal place again. And so as we've been saying, I cannot look at either one of these numbers and say those are good or bad. I need to compare it to something. And the comparison here is going to be to their competition, the Hershey company. Even though Hershey we already know is a much smaller company, we want to do this comparison. So I'm going to pause the recording and allow you to do the calculations for Hershey for both Part A and Part B, and then please restart the recording. And so I got a ratio of liabilities to stockholders' equity of 5.7 for Hershey. You can see that that is much, much higher than for Mondelez. What that tells us is Hershey has a lot more debt or liabilities in their capital structure. And then looking at Part B, the ratio of fixed assets to long-term liabilities, Hershey also has a twice that ratio of Mondelez. And so they have a great deal of fixed assets compared to their liabilities, much more so than Mondelez does. So if we look at letter C here, we can fill in the blanks now. Hershey uses more debt, relatively more, dollar for dollar. No, Mondelez has a great deal more debt, but they're a much larger company. So although Hershey uses more debt, it has slightly stronger creditor protection and borrowing capacity, and you can tell that because of this ratio of fixed assets to long-term liabilities being much higher. So I have used the term capital structure quite a bit. So let me just briefly explain what I'm talking about when I say that. I suspect I may have said this in an earlier class, but I know I haven't said it in this chapter. So if I were to take the fundamental accounting equation and expand it, something like that. So this is the company's expanded accounting equation. I've expanded expanded liabilities to break out the current and long-term. Then I expanded stockholders' equity to break out the contributed capital, which is what the initial investments from their stockholders, and then retained earnings, which is the money the company made on its own. If I were to just bracket right here, I'm just going to put a bracket there. Oops, missed a little bit, and a bracket there. That I just tried to bracket in red is the company's capital structure. It's where the money comes from to do the rest of what they're doing. So they're borrowing, long-term liabilities, the issuance of stock to raise money, and then the money that the company earned internally, what I call internally generated capital. So when I make reference to the company's capital structure, that's what I'm talking about. The long-term liabilities and then both components that make up the equity. So when I say that a company is highly leveraged, I mean that they've got a lot of long-term liabilities specifically compared to their equity. And the reason I suggested that some investors might like that, might like the fact that the company is risky, here's my very brief and simplified explanation of why that's the case. Why having a lot of debt might also magnify returns for investors, for owners or equity holders. Let's say you issue debt that has a 5% interest rate. I'm just throwing numbers out there just to help you see this connection. So if we have interest, we have some bonds that we're paying 5% interest on those bonds, or we borrowed money, we're paying 5% interest. And let's say we borrowed that money to do some new project, maybe to build a new factory or invest in a new product line or something. That debt has a 5% interest rate on it. If the new project that we financed with the debt returns 3%, so we make a 3% profit on that new project, we still have to pay the 5% interest. And so the stockholders end up picking up the other 2%, right? So this is very simplified. So we still have to pay the 5% interest, but the project only made 3%. So the other 2% has to come from investors, okay? So the investors' return is going to go down because we still have to pay that 5% interest. Let's say the project returns exactly 5%. So the project allows us to pay the interest on the debt and nothing else. So no extra return for the stockholders. But anything past that 5% return, the stockholders are going to make money for no additional investment. So if the project returns 7%, the first 5% pays the interest on the debt, and then the other 2% goes to the residual stockholders. If the project makes 20%, the first 5% pays the interest, and now the stockholders have made 15% for no additional investment. And so when I talk about leverage possibly increasing the returns for stockholders, that's what I'm referring to. That the debt has, yes, it has to be repaid and it has to be repaid with interest, but that interest rate in most circumstances is a fixed interest rate. And anything beyond that, the stockholders get that difference in terms of their return. And so some stockholders, some investors are really interested in leveraged companies because it can really increase their returns, but definitely more risk. Okay, I'm going to put the green check marks in here if I can round that off. Any questions about these two calculations? Ratio of liabilities to stockholders' equity, ratio of fixed assets to long-term liabilities. There is no one way of reading that. There's no magic number for comparison. I absolutely would suggest that you shouldn't say risk is always bad, because some stockholders, some investors are looking for risky companies. But what we can do is the comparison like we just did here and talk about which one's riskier without attaching a label of whether that's a good thing or a bad thing. All right, let's go, jump ahead here. And we'll move on to exercise 8 in a moment. Exercise 8 deals with profitability analysis. So we talked about last class that companies have two main goals in the near term, that is making money and paying their bills. But then we brought in that third category of long-term solvency as also being important for the future of the company. So we're now shifting our attention to those profitability ratios. And quite a bit of what we're looking at then is dealing with the income statement. Are we making enough money? And so in our next couple exercises, we're going to be looking at both profitability in exercise 8, and then in exercise 9, we'll review what we did with solvency in the last exercise plus profitability. And then And then we'll move on to our final concept, which is looking at the stockholder return piece. So lots of different profitability ratios on here. I would suggest that some of these are not truly profitability, but more market strength related to return for investors. So earnings per share on common stock, kind of a profitability because it relates to earnings, but it also is more of a stockholders' equity question, whether the stockholders, whether the investors are making enough money. I would say the same thing is true for the PE ratio and the two dividends calculations, that lumping them into profitability is a little bit misleading, but that's okay. As I've already reminded you today, you do have these formulas in the, excuse me, you do have these formulas already in the reference materials folder in Blackboard. You may want to make a note of them, but we're going to very quickly here just jump to our exercise. I just want to do a brief overview on what these measures will be. So asset turnover is a measure of how good we are at using the assets we have to generate sales. How good we are at using the assets we have to generate sales. So you'll notice the denominator here, average total assets excluding long-term investments. We talked about in chapter 4 when we talked about the classified balance sheet, what an investment would be for a company. That could be an investment in a financial asset such as stocks or bonds in other companies, that the intention is to hold them long-term. It could also be investment in real property that we're not currently using in the normal course of operations. Return on total assets is again a look, there's that, the numerator is that EBIT calculation. So a return on total assets is how good we are at using the assets we have to make money. So related, similar to asset turnover, how good are we at using the assets we have to generate sales? But now we're looking at how good are we at using those assets to generate income or earnings. Return on operating assets is another calculation that may be of interest to us, looking at the operating income, so that's before taxes, the operating income compared to the average operating assets. Another measure you might be interested in knowing is how good are we at producing income based on our equity. So we're not using the equity, but we're leveraging that equity to produce income. And so return on stockholders' equity is another measure that might be of interest to us, especially if we are a stockholder or considering becoming a stockholder. Now, anytime we're using these calculations, you need to keep in mind that this calculation is based on the book value of our equity, not the market value. So when we get to the calculations of earnings per share and dividends yield, those are based on the current market value of the stock, which is a much more reliable indicator than the book value of our equity. Because remember, the contributed capital part of our equity represents the initial investments when the stock was first sold, and it does not take into account changes in the market value as the stock changes hands between one private investor and another. I've already talked about leverage, so we don't need to belabor that point. But I have already really explained to you the concept of leverage and how it can magnify or increase the earnings for the stockholders by taking on debt with a set return or a set interest rate. Excuse me. One more calculation and then we'll go to our next exercise, and that is return on common stockholders' equity. So return on equity that we saw on the previous slide here is the total stockholders' equity. But if you think about what you know about preferred stock has a set dividend rate, kind of like bonds have a set interest rate. So if you are a common stockholder, we already know from chapter 12, we have to pay the preferred stockholders their dividends first, but then we get whatever's left. And so a more relevant calculation might be what's on the screen right now, which is the return on common stockholders' equity. So we remove the preferred dividends because we know that's all they get, and then compare that to the common stockholders' equity. So let's go to our exercise. You've now seen all of the formulas. I will repeat them for you as we go through the exercise. I just wanted to do a brief coverage so that you knew what it is that we're actually measuring with these ratios. So let's go to exercise 8. The following selected data were taken from the financial statements of VitaHill Incorporated, and they're for 3 years running. So we have total assets, we have notes payable, common stock, preferred stock, and retained earnings. We're then given the income for each one of the most recent 2 years. We're told there were no dividends on the common stock in those 3 years, but that they had declared and paid the dividend in full for the preferred stock. So since they just said that, let's calculate what the preferred stock dividend would be. I'm just going to stick that right up here at the top. So let's find the preferred, let's not do that in red. No. Let's find the preferred dividend, abbreviating. And so the preferred dividend is on the $500,000 worth of preferred stock. And the dividend rate, we're told, is 4%. Quite fit in there. So what we find is that the preferred dividend that was, we're told, declared and paid in full for both of the years in question would have been $20,000 annually. So we'll start with the return on total assets. I think if you hover here, oh, it doesn't really actually tell you. I was hoping it was going to show you the formula because I know I may have gone through those more quickly than you were writing them down. Again, you can refer to those pages in their reference materials, but I'll also tell you what the formulas are. In the interest of space, I don't really want to write all of them on the screen because we'll run out of room to do the actual calculations. Does anyone need me to write them on the screen? Okay. So I'm just abbreviating this. Return on total assets is our first calculation, and we're going to do the 2017 ones together. So return on total assets is the net income, and we're told that the net income in 2017 was $372,000. Oh, I need to do another calculation. Sorry, I just realized they didn't actually give us the interest expense. We have to calculate that. So let's calculate the interest expense on those notes payable. So we know that what shows on our balance sheet is the face value or the principal amount that we borrowed, and it tells us that the interest rate is 8%. And so the annual interest would be $180,000. Okay. Now let me start on the return on total assets. Oops. Okay, So we started with the net income, which for 2017 was $372,000. We add back to that the interest expense that we just calculated was $180,000. And then we divide that by the average total assets. So just like we talked about with average receivables, average inventory, we know that we're going to be adding the beginning and ending. So adding the beginning and ending assets together and dividing by 2. Make sure you get your grouping symbol together there. It's probably easiest to make, unless you're very comfortable with your calculator, it's probably easiest to calculate the average assets first. So averaging together the beginning balance, which was the 4.4 million, and the ending balance, which was the 4.8 million. The average of those, of course, would be 4.6 million. And then divide that into, so 372,000 plus 180,000. Divide that by the 4.6 million, which is the average total assets. Plug that correctly into my calculator, I got 12%. Let's tell us to round to 1 decimal place. So 12.1 or 12.0%, 12% even return on total assets for 2017. Go ahead and do the calculation for 2016 on your own. They told us the interest, the notes payable hadn't changed, so it will still be that same 180,000 in interest. But the net income for 2016 was much higher at 492,000. And so the net income plus interest expense would be 672,000 divided by the 4.2 million average total assets. And you can see that the return on total assets was much higher in 2016 than it was in 2017, significantly higher. Why is that? Well, their assets went up, but their income actually went down. So both of those things worked against their return on total assets. More assets, less income. Any questions about that one? Okay. Let's move on then to our second calculation, which is return on stockholders' equity. And this is normally abbreviated ROE, return on equity. Remember, this is the total stockholders' equity, so we're not yet taking into account those preferred dividends. So the return on equity is the net income. So for 2017, that would be 372,000 divided by the average total stockholders' equity. And we don't. Do we have the equity? Okay, so we'll have to calculate the equity because I don't see where they've given it to us. So I'm actually going to step away from that, fit in down here to find our equity. If you keep in mind the fundamental accounting equation, assets equals liabilities plus equity, and we have our total assets. Actually, do they tell us? Yeah, I guess we can find our equity by just add. We don't have to go through all of that. We can find, whoops, here. We can find our equity by simply adding together all of the pieces that make up their equity, the common stock, the preferred stock, and the retained earnings. So to find the average for the 2 years, we're going to have to add together the common stock, the preferred stock, and the retained earnings for both years, and then divide by 2. So let me, I'll put this on the screen. You can go ahead and calculate it on your own if you'd like. I'm just going to try to make this a little simpler to fit it in here. Still not going to fit. So that's our calculation. And maybe I can just drag this down here to the bottom to fit it in. There we go. So that's our calculation. 250,000 times 2 for the common stock, plus 500,000 times 2 for the preferred stock, plus retained earnings for each year, and then divide that by 2. And so for our first year, the most recent year, the 2017, the average stockholders' equity, if I did my math correctly, was $2,148,000. So now we can find our return on equity, or ROE. This is normally expressed as a percent. So you want to move the decimal 2 places to the right and add the percent sign. We got return on stockholders' equity of 17.3% in the most recent year. Let's go ahead and do the return on common stockholders' equity, since we have all of that information on the screen already for 2017. This is not such a common abbreviation, return on common stockholders' equity. I don't want to, ROE is a very common abbreviation. This one is not. I'm just trying to make sure I'm saving room here on the screen. So return on common stockholders' equity is basically the same calculation, but instead of using all of the income, we subtract the preferred dividends first. And instead of using all of the equity, we're going to subtract out the 500,000 that is the preferred equity. So our initial 2,148,000, which was the total, we're going to subtract the part that's the preferred equity. And rounding to 1 decimal place. On the percentage, we got 21.4%. So what does that tell us? That their return on common stockholders' equity is higher than the return on stockholders' equity. Once we take out the preferred dividends, remember the preferred dividends we talked about in chapter 12 have a stated dividend rate. They're always getting, anytime dividends are paid, they get 4% dividends. But if the company's making more than 4%, then more of those earnings accrue to the common stockholders. The preferred stockholders never get more than that 4%. Okay, any questions on this so far? Okay, I'm going to pause the video and ask you to do those 2 calculations for 2016. As usual, I will do mine on the screen and then restart once we finish up those 2. We'll answer the questions in part B. Okay, so I've showed my calculations here on the screen. I calculated the average equity down here at the bottom, plugged that into the return on equity and found a return on equity for 2016 of 28.3. And then the return on common stockholders' equity, where we excluded the preferred dividend and the preferred equity, that calculation gave us 38.2. And so, as we've been saying right along, we can't look at any of these numbers in a vacuum. We need a comparison. And so here we have a comparison from 2016 to 2017. The profitability ratios indicate that the company's profitability has deteriorated. So definitely higher is better on all three of these calculations. Since the return on common stockholders' equity exceeds the return on total assets in both years, there is positive leverage from the use of debt. Okay, so this company has some significant leverage, and they're using that to the advantage of the stockholders. Any questions about these arguably profitability ratios? Again, I don't necessarily think of the equity piece as it relates to profitability, but they're consolidating categories, in my opinion. All right, if there aren't any questions, I'm gonna, clear my screen here. And I'm just gonna show you exercise 9, 6 measures of solvency or profitability. The 6 measures that we are asked in this exercise are all review or additional practice with ones that we have done in an earlier exercise, except I think we didn't do asset turnover or return on total assets. So let's do those together. Asset turnover and return on total assets, and then we're going to move on to exercise 10. And at the end of class, we'll come back if you want to work on these. I'll ask you to try those on your own, but we can do that at the end of class while I'm still here to answer questions if you want to do that. But let's just skip to letter C, asset turnover. Again, we saw these calculations already in the PowerPoint, but I will remind you. So asset turnover is normally abbreviated AT. That's a very common abbreviation. And the calculation is sales divided by average total assets. And we're going to exclude from that any long-term investments. I can long-term investments. Okay. So there's the formula. I should have, let me just try to group that together. They should have put brackets or parentheses around that to keep that denominator together. And so given the information here, let's calculate our asset turnover. So we are told that for the year, the sales were $18,900,000. And we're going to divide that by the average total assets. It does tell us that long-term investments totaled $3 million throughout the year, and total assets were $7 million at the beginning of the year. Excuse me. So to average those together and take out the long-term investments of $3 million. So at the beginning of the year, it was $7 million. Take out the $3 million in long-term investments, we left with $4 million at the beginning of the year. Whoops. I'm going to have to scroll up here. So it doesn't give us the total assets from the beginning of the year. I'm going to have to calculate that. We are given our total liabilities of $3 million and our total equity of $5 million. So from the fundamental accounting equation, assets equals liabilities plus equity. So it must be $3 million plus $5 million or $8 million. was our total assets at the end of the year. And we know that 3 million of that 8 million was long-term investments that we need to exclude or remove from the formula. So that leaves us with 5 million. I'm going to have to jump down here, I guess. So we're averaging together 4 million and 5 million. There. Oops. There. So where we are now, we have $18.9 million in sales in the numerator. And in the denominator, we've removed the long-term investments from the total assets, and we're averaging together 4 and 5 million, which of course is 4.5 million. And so my asset turnover for the year would be 4.2. 4.2. What does that mean? For every dollar we have in productive assets, so we're removing the long-term investments because by definition, those are not being used in our normal course of operations. So we have $4.5 million in productive assets, and we're using those to produce $18.9 million in sales. That equates to $4.20 for every dollar in productive assets, or an asset turnover of 4.2 times. I can't stress enough, I can't look at that number and say whether that's good or bad. I don't know what this company does. I don't know what's standard in their industry. I don't know what they did last year. And so we have to have something to compare that to say whether that's good or bad. I have no idea just looking at it like this. Let's move down then to letter D, which is the other one that we have not yet done. And we have, I'll put the formula on the screen. Return on total assets, frequently, typically abbreviated as ROA, return on assets. And it's understood that if you use ROA, you're talking about their total assets. So the numerator is net income. Oops, I should have put that parentheses there. Net income. And we're going to add back the interest expense. And the denominator is the average total assets. So there's our formula. Net income plus interest expense divided by average total assets. So in our numerator, I'm going to have to scroll up. Right? Oh, there it is. Their net income for the year was $930,000. Didn't actually have to scroll up at all. $930,000. The interest expense on the bottom line of that table was $120,000. We know that our assets at the beginning of the year were 7 million, and at the end of the year they were 8 million. So the average of those two would be $7.5 million. Whoops, got an extra zero in there. Just cross that out. Okay, so from that, you should be able to do that final calculation for ROA, return on total assets. %. So for every dollar in assets, they're adding 14 cents to the bottom line. Another way of interpreting that result. Again, we cannot look at that number and say that's good or bad. You have to compare it to something else. How did we do last year? What other companies like us do? So there is no rule of thumb for these two numbers, return on total assets or asset turnover, because it's pretty industry specific. Some industries are very asset intensive. They have a lot of sunk costs or upfront costs, a lot of stuff, a lot of equipment and facilities that are needed. And other companies are more knowledge-based and less asset intensive. And so their return on assets would be much higher than like a heavy manufacturing company that needs big machinery and equipment and so on. All four of the other calculations, A, B, E, and F, we have already done. So as I said, I'm going to leave those for you to calculate on your own after we finish up the last set of ratios or equations. Any questions though about these two that we just did? All right, let's move on to exercise 10. I'm going to skip ahead in, oops, I'm going to clear all that writing off my screen so we can see. And as I said, in this final exercise, we're really looking at the stockholder return, or what is sometimes referred to as market strength. And so one of the advantages, or sorry, one of the criteria for these market strength calculations is we're looking at market value. What happened in the market in general? So our first calculation is going to be earnings per share. And you can see this is for, oops, there's a typo there. There should be two R's together there, of course. The earnings per share is for common shareholders. This calculation always appears on the corporate income statement. It must be included there. This is a little bit of a simplification because the denominator is shares of common stock outstanding, but because the earnings is for the year or for the time period, if the number of shares has changed during that time period, we have to take that into account. So and do a weighted average. We're not doing that for class, but I just want you to be aware that if a company has sold stock or repurchased stock as treasury stock during that period, it's not a strict, how many shares are outstanding at the end of the period. We would have to take that change into account. We also exclude or remove the preferred dividends from the calculation because we're looking just at the common stock. How much money did you make for us as common stockholders? And so hopefully you made a note of that calculation, and we'll move on. Oops, there we go. To the second calculation we're going to do in exercise 10, which is the PE, or price to earnings ratio. This is expressed as a number of times. So the earnings per share calculation is expressed as in dollars per share. PE ratio is expressed as the number of times. And as I already pointed out, we're going to use the market price as of a specific point in time. So it's usually going to be, like the last day of the year. Compare that to the earnings per share. This is how we determine really whether a company is a value stock or a growth stock. So again, if you follow the stock market, those two terms might sound familiar to you. A value stock is one that the market sees as being maybe underpriced, and a growth stock is one that you expect that company to be generating future earnings. And I'll bring that up again when we look at the exercise. So hopefully you've made a note of that ratio. The third calculation in exercise 10 is dividends per share. This is again a common stock calculation because the preferred stockholders know how much their dividend is. It's always the same whenever dividends are paid. So it's the total dollars that we're declared as dividends divided by the number of shares of stock outstanding. Again, if there was a change in that number, we'd need a weighted average. Oops. And finally, the last calculation in exercise 10 is dividends yield. So this is as a percent of the market price, how much do we expect in dividends? This is part of the return for investors. So if you own stock in a company, there are two different ways in general that you make money on that stock. One is by receiving dividends. Another is because the price of the stock hopefully goes up over time, or price appreciation. I think I said in chapter 12, and actually I'm quite sure I said, that not all investors want dividends. Dividends are a taxable event. And so some investors would prefer not to receive dividends because then they have to pay tax on them. Other stockholders might prefer the company just hold on to their money and use it to make them more money without it being returned to them. You buy stock in the company because you want the company to make money for you using your money. And so one argument against dividends is, why would we want to give it back? Why are you giving it back to me? Keep using it, make me more money. So dividends yield, if you want dividends, a higher dividends yield is better. But if you prefer not to receive dividends, you're really looking for a dividends yield of 0. A company that doesn't pay dividends has a dividends yield of 0. So those are the 4 calculations that are new for exercise 10. So let's go to exercise 10 and take a look at each one of these 4 calculations. The following information was taken from the financial statements of Tolbert Incorporated for December 31st of the current fiscal year. We can see the dollar amount of their common stock and preferred stock. Here's their net income. The declared dividends on the common stock were $1,125,000. Market price at the end of the year was $45 per share. One extra calculation we're going to need, because it is not given to us, is how much the preferred dividends were. So I'm going to go ahead and do that calculation right now. So the preferred dividend rate So it actually tells us it's $4 rather than the percentage that I was looking for. So we have to calculate how many preferred shares there are. So this is just a little bit different than what we have done. Put a $sign there. Than what we have done in the past. So we don't know how many preferred shares there are. We need to calculate that. We're told that the dollar amount of preferred stock is $2,500,000. And it has a $40 par value. $2,500,000 divided by $40 tells us that there are 62,500 shares. And each one of those shares pays a $4 dividend. Just a little bit different information presented to us there than what we are accustomed to seeing. So the dividend on the preferred stock would be $250,000 a year. And we know that that must be being paid in full because they declared dividends on the common stock, and they cannot do that if they haven't paid the dividends on the preferred stock first. Everybody with me so far? Okay, so let's go ahead with the earnings per share. Get my annotate back up here. So the earnings of this company, net income was $1,750,000. but we want to subtract from that the preferred dividend. And then, because this is how much is left for the common shareholders. So this is not how much they were paid out in dividends. This is how much money the company made for the common shareholders. You know, if you look at the company's income statement and you see they made $1,750,000, you're like, cool, that sounds good. But how much of that is yours as a common stockholder depends on how many common stockholders there are. Are there 1 million common stock shares? Are there 5 million, 500 million? Makes a difference. Oh, and I now see they didn't tell us how many common shares there were, so I still need to calculate that. Common shares. So there was $10 million in the common stock account, and that's a $20 par value. So that's 500,000 shares of common stock. Okay, it says round to 1 decimal place except for dollar amounts, which should be rounded to 2 decimal places. And so earnings per share is definitely a dollar amount. The company made $1,750,000, but $250,000 of that was paid out as dividends to the preferred stockholders, leaving $1.5 million in earnings for the common shareholders. And if we divide that by the 500,000 common shares, it's $3 per share. Make sense? Again, we need something to compare that to. Is that good or bad? Sounds pretty good, but I don't know how that compares to the price of the stock. If they made $3 and the price of the stock is $3, that's really good. If they made $3 and the price of the stock is $300 or $3,000, that's not very good. And so that's where the next calculation comes in, the PE, or price to earnings ratio, PE ratio. And we take the earnings per share, whoops, and compare that to the market price. So we're told the market price is $45 and the earnings per share was $3 as we just calculated. So the PE ratio would be 15 or 15.0 or 15 times. What you might hear if you follow the stock market is the stock is trading at 15 times earnings. As I said, this can be used to evaluate whether this is a growth or a value stock. A value stock is generally one that's been around for a while or the market sees as underpriced. You're buying existing earnings. You get high earnings compared to the value or the price of that stock. Typically, a PE ratio below 15, we would say that's a value stock, and the lower that number is, what that tells you is the market doesn't see this as a stock that's going to be bigger in the future, but it's one that might be a steady earner right now. If the PE ratio is greater than 15, then we would generally call that a growth stock. So it doesn't have a lot of earnings right now, but the price of that stock reflects that the market believes that stock is going to be more profitable in the future. I'm aware that we're running out of time, so let's keep moving unless someone has a question. So dividends per share is very straightforward. We're told that the dividends on the common stock were 1,125,000, and we've already calculated there were 500,000 shares. And so the dividends per share, again, is expressed in dollars $2.25. And just like we said with the earnings per share, that's really, you know, a nice number to know how much did I get in dividends per share. However, we need to relate that to the market price. And so dividends yield is the dividends per share, which we just calculated, divided by the market price per share. And it works out to be exactly 5%. So dividends yield, the company paid out 5%, you got a 5% return even if the stock price didn't change during the year. If the stock price went up, you would calculate that as a percent, then add that to this 5% dividend yield to know your total return on that investment. Because as we already said, you can make money on this stock two different ways: by receiving dividends, just got a 5% return, and by the comparing the price on the stock, what happened to the price on the stock. Hopefully it went up during the year, and that will increase your return on investment. All right, it's 10:40. We are out of time. We have done everything except those 4 review calculations here in exercise 9. Does anyone have any questions before we call it a day and a semester? All right, well, thank you all for being here. Wish you the best of luck with the rest of the semester and the rest of your career here at JCC, and please let me know if there's anything I can do to help you as you finish up this semester.